Why are so many people leaving the UK right now? And why is Dubai the #1 destination for them? If you live in the UK, make a decent income, and feel like you're paying more tax every single year, you're not alone. In this video, I'll break down why thousands of entrepreneurs and investors have already left the UK, what changed after the 2025 reform, and why the UAE has become the obvious solution for those who want to protect their wealth and freedom. Let's be honest, the UK has become an expensive place to earn money and a risky place to keep it. Business got more expensive. The corporate tax rate jumped from 19% to 25% in 2025 for profits above £250,000. For many businesses, that's tens of thousands of pounds lost each year. The more you earn, the more they take. Simple as that. The non-dom regime is officially over. Since April 6, 2025, the UK has abolished the old remittance-based system. Going forward, if you're a UK tax resident, your overseas income and gains are taxable in the UK, even if you don't bring them into the country. The familiar model, I live in the UK but only pay tax on what I remit, is gone. It's been replaced by a 4-year foreign income and gains relief for individuals who become a UK resident after at least 10 years abroad. If you're already a resident in the UK and don't qualify for FIG, the door to those exemptions is closed. Own foreign property, investments, dividends, or crypto? Since April 2025, you'll likely pay a UK tax on them as they arise, not just when you bring cash home. More taxes are coming. The government is openly discussing an exit tax, a tax on unrealized gains when you leave the country, similar to the French model. It's a proposed 20% charge on business or investment assets of individuals relocating abroad. They're also debating a wealth tax and higher inheritance and property taxes. These are no longer rumors, they're active policy discussions. More control, more compliance. The UK fully participates in the Common Reporting Standard. That means HMRC automatically receives data about your bank accounts and assets abroad wherever you've declared yourself a UK tax resident. Paper companies and offshore placeholders don't work anymore. In a connected world, you either structure smarter or pay the price. So what does this mean in practice? If you're a business owner or investor still based in the UK, the longer you wait, the more expensive it gets to stay. And it's not just the ultra-rich. Mid-sized business owners, consultants, crypto investors, they're all leaving. Because every year, the rules tighten, the taxes go up and the freedom goes down. Banks ask more questions. HMRC sees everything through the CRS, and there are no new reliefs in sight. One of our clients, a UK-based tech entrepreneur, had spent over 20 years building his company in London. Over time, he set up a holding company overseas to manage financial assets and real estate across several countries, properties generating rental income and a few long-term investments. He's married with 2 children in school, and the family had planned to relocate to Dubai in 2025. But due to school admissions, they postponed the move until mid-2026. That single delay changed everything. Because he remained UK tax resident throughout 2025 and 2026, the end of the non-dom regime in April 6 pulled all of his offshore income and gains into the UK tax net under the new FIG rules. Under the SRT test, his family ties, London home and daily management, HMRC treated him as a fully UK resident. As a result, his holding company's dividends, foreign rental income and capital gains became taxable in the UK. His final tax bill, 6 figures. All because the move came 1 year too late, before establishing residence and substance abroad. Had he exited properly before the reform took effect, that entire exposure could have been avoided. Let's talk about how to leave the UK properly and legally. First, exit the UK tax residency the right way. Follow the statutory residence test. It defines your residency based on days, ties, and the center of life. You need to show that your management, income, and daily control are no longer in the UK. And that's how you prove to HMRC that you really left. Second, become tax residents elsewhere, anywhere, ideally in a low-tax country. The most popular option today is the UAE, Dubai, 0% personal income tax and 9% corporate tax. Top-tier banking, infrastructure, and safety. And of course, a growing population, plenty of business opportunities, and world-class education. You can build and run your business here completely legally and comfortably. Third, create real substance in the UAE. Have local directors, an office or management base. board meetings, and actual income-generating activities and decision-making inside the Emirates. This is required under the UAE Economic Substance Regulation and will be required from a tax perspective from other authorities looking in. Without it, your setup looks fake, and banks or tax authorities won't accept it. Now is the best time to move, not next year. The non-dom reform is already in force, and HMRC keeps releasing new guidance that makes it even stricter. If you exit the UK in this tax year, you can still optimize and restructure peacefully. Wait another year, and it will cost you far more. At GCD Structuring, we help British entrepreneurs and investors make this move end-to-end, from analyzing your current tax status and designing your exit plan to obtaining UAE residency, licenses, banking, and substance. We handle it all. Book a consultation via the link below or visit gcdstructuring.com. One properly built structure can save you hundreds of thousands of pounds and secure your future. Dubai isn't just about low taxes, it's about clarity, opportunity, and control. Here, you run your business and your life on your own terms. My name is Peter Ivantsov, Managing Partner at GCD Structuring. Subscribe to the channel. We talk about tax, business structures, and relocation strategies without myths. And remember, financial freedom starts when you control your money, not the tax office.